So what we're going to go through and look at in this session is something that may or may not crop up within your exam. It's a very small area of the syllabus, but something that you will need to go through and keep an eye on just in case it were to crop up. What we're looking at here is tax exhaustion. Because what we've seen in the previous sessions, when we've gone through and looked at our tax in our net present value calculations, we have always had the scenario that the profits that the company had generated during the year were more than the capital allowances that the company was claiming from using its non-current assets. Here what we have is the scenario whereby the capital allowances that we are claiming within a year may be greater than your profits before tax. Now, if your capital allowances are greater than your profits before tax, then that means you can use all of those capital allowances to remove the profits before tax for the year. So therefore you will have no tax charge within that current year. However, there will be then additional capital allowances that you have not yet used within the year. Those additional capital allowances can then be carried forward to the next accounting period. So whenever you are there within an exam question, you just need to have a quick check whilst you're working through the question. And you need to go through and ask yourselves what's happening within this scenario. In that given year, are the capital allowances greater than the profit before tax figure? If you spot that within the exam, then what you need to go through and do to deal with it within the question is that, first of all, there will be no tax in that current year, because the capital allowances that you have claimed are going to reduce your profits chargeable to corporation tax down to zero. If you then have any unused capital allowances, then those unused capital allowances are carried forward to the next period. How are we going to go through and look at it? Well, as always, let's go through and have a look at a short, brief example. In this example here, the requirement asks us to go through and calculate the net after-tax cash flows for each year of the project. And as you can see there, we have years 1, 2, 3, 4 and 5. And each of those years we have generated some profits before tax, which at this point we'll just assume that those profits before tax are equivalent to our taxable cash flows. So each year you will then be subject to corporation tax on those cash flows at the appropriate rate. Here we are told that the corporation tax is there at 25%. So every year we'll be claiming tax relief at 25% on those profits before tax. However, that's before we go through and consider any capital allowances. Because what happens within this project is that we have there the purchase at the start of the project of an asset for £20 million. That purchase of the asset will then give rise to capital allowances over the life of the project. So here, 5 years. The capital allowances that we are told is that we have there 20% straight line allowances, and we're told that the tax is allowable in the year. So in year 1, we'll be able to claim the allowance in year 1. It's not looking there at any tax time delay and claiming the allowances in T2. So nothing overly complicated here. However, what we can do before we start going any further within the example, we can go through there and straight away we can begin to calculate the amount of capital allowances that the company can claim each year. We were told that it's a 20% allowance on your £20 million that you have gone through and bought at the start of the project. So there, if we take 20% of your £20 million, that will give you allowances of £4 million per annum, which we can use to reduce our profits before tax before we are then taxed to get the cash tax flow. What you need to be careful of here is you then need to look every year and see whether or not that your capital allowance that we have here of 4 million is bigger than the profits before tax. So let's have a look and see what we have for each of the individual years. So what we can go through and do is we can look at each of the years 1, 2, 3, 4 and 5. And all we're going to go through and do there is say, look, let's look at the information from the question with respect to profits before tax, because we have there 6 million, 5, 4, 3 and 8 million pounds respectively for years 1 through to 5. If we then look at our capital allowances, well, the capital allowances that we were claiming were there at 20% straight line on that £20 million. So as we said, you have there 4 million every single year. What you need to go through and do then is ask yourself the question, are our capital allowances greater than our profits before tax? Well, here in year 1, no. Your profits before tax are more than your capital allowances, so we just treat that as any normal year. Similarly, for years 2 and 3, our capital allowances are not greater than our profits before tax. However, it's there in year 4 where the capital allowances that we claim of 4 million are greater than our profits before tax. So that will be the scenario there whereby we take the capital allowances, we use them to extinguish the profits for the year and have no tax in the current year, and any remaining capital allowances are then carried over to the next year, whereby we just treat it as then any normal year, because there your capital allowances are not greater than your profits before tax. So we've identified the key year that's going to be important within this question. But as you can see, for all the other remaining years, it follows exactly the same as what we've done previously. So it's just something very small that may crop up within your answer. Even if you didn't spot it within the question, it's not going to go through and lose you an enormous amount of marks. So let's just go through and complete the question by asking what it specifically required. It wanted us to calculate the net after-tax cash flows. So here we have it. We've got the years 1 to 5 in our project. We've got our profits before tax for each of the 5 years. First thing that we're going to go through and do is just tax those profits at the corporation tax rate there of 25%. But just remember, we've got there that 4th year whereby we had said before that the capital allowances were greater than our profits before tax. If that's the case, there's a bit of tax exhaustion. So remember what we said there is that there will be no tax in that year, and any unused capital allowances will be carried forward. So it's only really year 4 and onwards that we then need to think about. Everything from years 1, 2 and 3 is the same as before. So 25% of 6 million is 1.5 million. 25% of 5 million gives me 1.25 million. And then there, 25% of 4 million is there at 1 million. What have we then got? Well, let's just leave years 4 and 5 for the time being. Let's just look at the other years that we have. Remember, your capital allowances that you were claiming, the savings that you then make on them are there at 25%. So 25% of our 4 million is there at £1 million. So all we've gone through and done there is we've just done 25% of your 4 million for each of those years. Now what have we got in that 4 here? That's where the fun starts, if you like. Because what you've got there is we've gone through and exhausted our capital allowances. There's a bit of tax exhaustion as the capital allowances are greater than your profits before tax. So what are we going to have there? Well, we had there profits before tax of 3 million. So the capital allowances that we're going to go through and use will be 25% of the 3 million. So 25% of the 3 million are going to be there at 0.75. Remember, we've not paid any tax on the profit, but we are making a tax cash saving using those capital allowances. Because what we then have, don't forget, is that now we've used 3 million of capital allowances, 1 million of those, remember we had 4 million to claim, 1 million is going to be rolled over to the next accounting period. So that there being T5. So what we're going to have there in T5 is we're still going to claim 25%, but that's going to be there based on your original 4 million plus the 1 million that's been rolled over. So 25% of our 5 million. 25% of 5 million gives me there 1.25, and what you can go through and do then is just total up all the columns to work out your net after-tax cash flows. So what have we got on the net after-tax cash flows? Well, there, in year 1, we end up, is that with 5.5 million, so 6 less the 1.5 plus the 1. In year 2, what have we got? Does that give us 4.75 million? In year 3, that's nice and straightforward, that gives us 4 million. In year 4, remember, there's no tax to pay in the current year, but we claim the capital allowances of 0.75, giving me 3.75. In year 8, what we've got there, don't forget, 25% of your 8 million just taxed as normal at 25% to give you the 2, and that gives you then your net after-tax cash flows of 7.25. So if you like, reducing the overall tax bill in that 5th year as we had those unused capital allowances carry forward to T5. There you have it, full-blown worked example. I'm sure you can imagine there wasn't anything overly technically difficult, nothing too cumbersome. You just need to make sure that when you're looking at a longer NPV style question, or maybe even a valuation style question that we'll see later in the syllabus, that you just go through whilst you're working your answer, look at the capital allowances, see whether or not they are greater than the profits before tax, and if so, you have some tax exhaustion.